Big news today, folks. Global bond markets are flashing red, and the spotlight isn't just on the U.S., the United States for once. With our deficits, it's crossing the Atlantic, where the U.K. and France are center stage. Finally, both countries now hold the dubious honor of running the second and third biggest fiscal deficits in the developed world. The U.S. is still the reigning champ, surprise, of overspending. Of course, no surprise there, but London and Paris are quickly catching up. Investors are losing patience in the UK. Markets are questioning whether their fiscal trajectories are sustainable. I mean, in France, it's worse. They're staring down political chaos with a looming vote of no confidence there. That's not just a headline. I mean, that's a direct threat to fiscal stability in Europe's second largest economy. And here's the kicker. All of this is hammering the euro. The weaker the euro gets, the stronger the dollar becomes, which is great for the American tourist sipping on wine maybe in Paris, but it's not so great for the risk assets across the globe. I mean, a stronger dollar tightens financial conditions everywhere. It pressures emerging markets, and it makes debt more expensive. What we're witnessing is a global bond tantrum. Europe's political and fiscal dysfunction is colliding with America's spending addiction. And markets, they're telling us loud and clear, the math just isn't adding up. So let's add up with some of that math with Eddie Ghabour. Welcome to the show, Eddie. Looking forward to this.
Thanks for having me.
Yeah, so I mean, there's a lot going on. There's so many topics to talk about, but I really wanted to hit on this with you because you've been pretty outspoken about the Federal Reserve making a pivot, a really outspoken pivot just a few weeks back with, the event they held, and they got more dovish than they have been in a while. What's your overall take on the trajectory of interest rates when the 30-year Treasury right now is trading at the highest it's been since 2023?
Look, I think one thing that investors should know is ultimately at some point in time, this poor fiscal policy and the amount of debt that we have around the globe, to the point you made earlier, it will have a breaking point and implode at some point in time and rain on this bull market parade. So we have told our clients that when this bull run ends, it will be ugly because of this. There is a price to pay for poor monetary policy and managing your debt irresponsibly. But in the meantime, what we're focused on is here in the near term over the next 6 to 12 months, we believe that economic growth will accelerate to a point where the markets won't worry about rates going up. But I think we are in a new normal. We have told clients this, where inflation is going to stay high. Interest rates are going to trend higher over the next decade. That is the world we're going to be in. And this is why for our clients, we took a big percentage of what normally would go to fixed income, and we've used gold. And we started that last year, and it's worked out well. It's a defensive asset that should do well in that type of environment. But you have to adjust to this new normal because, in our opinion, it's not going to change.
Well, I check on gold every single day. It just seems to step higher and higher and higher. I think that's a great decision there. And when it comes to the global kind of outlook, when it comes to inflation, why has the Federal Reserve just said, hey, 2% is the target? I mean, what kind of history and historical data are they using? It's kind of like this flat line in the sand that is kind of made up, right? So whether inflation is at 2 or 3%, it is way down. It looks like the trajectory for interest rates is lower. When we first start cutting here in September, here in a few weeks, it looks like, when we get that basis point cut, 25 basis point cut, most likely, what do you think the pathway of the U.S. markets is? Like you said, is it up right away? Is it certain areas? Is it small caps that are finally seeming to catch up? Where would you be putting new money to work right now?
We believe the rotation trade that has been a head fake over the last couple of years is not a head fake this time. And we have we've broadened out our portfolio. And for investors, I think this is a really good thing. You don't have to be so concentrated in the Mag 7. So for the last few weeks, we've been telling clients and we've been sharing with everyone that we have rotated in the small caps, consumer discretionary. You can start to broaden out. Because if we're right in our thesis in regards to economic growth accelerating, the fact that the Fed is going to cut interest rates in a non-recessionary environment is unprecedented. And so that's going to cause, we believe, these asset prices to really get to new levels. And that's why I think you're seeing what's happening right now with tech. it has shown some weakness, but other areas have shown strength. And I'll add home builders on that as well, too. We've added that as well. So these are non-consensus areas that we think does well once we look past the month of September.
Well, we were just focusing on the United States there when obviously in the opening I'm talking about France and UK, spending issues all around the world. I mean, it feels like everyone's just addicted to spending money, whether you're in the U.S. or anywhere else, and governments just continue to borrow. We talked about tariffs earlier with another guest, talking about how bringing people to the negotiating table is bullish for maybe the international kind of countries because it's going to help the global economy. When it comes to asset allocation globally, I'm kind of staying away from Europe right now because of what I was referring to in the opening segment. Is there anywhere else outside of the U.S. you're looking?
Frankly, right now, we are staying 100% domestic. We believe there's more predictability there because I think we have a clear path. We have an administration, whether you agree with what they do or not is not the point. They tell you exactly what they're going to do, and they actually do it. And for us, that makes it an easier read in regards to which direction markets are going to go in and what areas to favor. So we have zero international exposure right now in our tactical strategies, and we're staying home here in the U.S.
That's bold. I like that. I mean, usually you hear 5, 10, 15% allocations somewhere in there, right, to international. So you are super bullish right now, it looks like, on the U.S. Where are you looking at on this pullback? I think we're 3 to 4% off all-time highs. We maybe have about 30 to 45 seconds here. Where are you looking on the top to bottom? I know you can't call exactly the number, but where are you looking on this drawdown? Is it 5%, 10%?
I don't think we're going to get to 10. I think 7, in my opinion, is a worst-case scenario. Too many people are underinvested, and these dips are going to get aggressively bought, in my opinion.
Yep, I like that. Eddie, thank you for being here. I always have fun with you. I know you're always rocking in New York with me. It's always a lot of fun. So, Eddie, thanks for being here, man.